Hello, everyone. My name is Anna Kate Merrill. Thank you so much for joining our webinar, which is Understanding the Corporate Transparency Act. We have our guest speakers, Cy Alba and Paul Tracy. Those of you who do not know me, and I don't expect you to, I'm new on the webinars. My name is Anna Kate Merrill, as I previously said, and I serve the proposal helper BidExec's company as the marketing corporate manager, as well as a business development account manager. So Cy, I'm going to pass the baton to you and let you introduce yourself, and then Paul.
Sure. Thanks, Anna. Okay, so yeah, my name is Cy Alba. I'm a partner law firm of PilieroMazza. We deal with all things for kind of small, mid-sized companies, mainly in the government contracting space. So, happy to be here. I know this is very new, so there's a lot of things we're going to go through. There's some guidance that's come out since the beginning of the year. That's why we wanted to delay this a little bit to get you that information. So hopefully there's some good nuggets in here, and then we'll go from there. And I'm here with my colleague, Paul. Paul, you want to say hi?
Sure. Hello, everyone. Thanks for having me. It's a pleasure to be here. I'm one of Cy's associates, and I deal with the business and transactions part of our practice. So if you have any questions about how the CTA might affect your business entity or your umbrella, that's kind of the area that I can help as well. But we've been looking into the CTA for about a year now. So happy to share what we have so far and help you in compliance.
Yeah, perfect. So I don't know, Anna, do you want to talk about things a little bit? Just an introduction. We can keep going. Keep going. All right, so let's get into the meat of things. So when you're talking about the Corporate Transparency Act, the CTA, my daughter thought I was misspelling cat this morning when I was looking at some stuff, and I said, nope, it's an acronym. It stands for the Corporate Transparency Act. We're going to go through a little bit of the history, but then mainly jump into all the specifics that you need to know, some of the reporting deadlines, when you have to report at a high level. There are nuances to some of this. In fact, we're comparing it in one area to some of the small business rules that I think people might be aware of, just because there's a lot of overlap or some similarities there with the ambiguity in how some of these things are defined. All right, so first and foremost, like, what is the Corporate Transparency Act? Well, it's fairly old legislation at this point in time. It's a few years old now. And the idea was to require companies that aren't already reporting on their ownership in some other way to start reporting that, mainly in order to stop things like terrorist funding or money laundering, that kind of stuff. So as a lot of people know, there are various places you can incorporate and try to keep your identity hidden. The idea here is to attempt to stop that so that you couldn't get bad actors. Now, there's a lot of reasons why people would want to be anonymous, and this frustrates some of that, which we're going to talk through, especially individuals that are setting up certain investment companies and things of that nature that don't have a lot of assets, don't have a lot of revenue, don't have a lot of employees. In those sorts of circumstances, you're probably going to have to start reporting. And this is something that could be available to individuals who are trying to find that information, be it for good reasons or bad reasons. So size protests, size appeals, trying to connect the dots. I'm sure fairly soon there'll be some sort of other websites that are not related to the federal government that might crawl through some of this data and publish it. I wouldn't be surprised if some of those corporate aggregators like Corporate Wiki or Manta or some of those other websites might start crawling through this data in order to get better and more accurate information for their own websites. Potentially, we'll see what happens with some of this stuff, but it's something that's going to be generally available. Again, you have to report this stuff with the Department of Treasury, the Financial Crimes and Enforcement Network, which is primarily, again, what this is all for. This is all to prevent criminal behavior. But at the same time, it's somewhat of a dragnet. It's going to sweep up a bunch of people who might want to stay anonymous for perfectly legitimate reasons and potentially cause just disclosures. All right. So why is it important? Well, it's really out there, right, to attempt to stop crime. At the same time, they really want to make sure that individuals are reporting this information and that everything that's being reported is accurate. So from that perspective, if you don't report things or you provide false information, you could have civil or criminal penalties. This would overlap, by the way, with other enforcement mechanisms that the federal government has. So similar to when you have False Claim Act issues, the government often goes after people for wire fraud or bank fraud or other things like that, in addition to the standard false claim remedy. That, I think, is going to be the same sort of thing that could happen here. We're not sure how much they're going to enforce this or how stringent they're going to be, but there's the possibility here that you could have civil penalties up to $500 for each day that a violation continues. So if you have a situation where, and we'll get into the reporting timeframes later, but if you have a situation where you're supposed to report, they can be tight timeframes and you don't. And then for whatever reason, there is enforcement on this or someone looks at it, this is a hefty penalty, especially for small companies. And that's a key driver of this, are smaller companies having to report their information. Because the really, really big guys, the publicly traded companies or the companies that are owned by a lot of private equity investment, things like that, there's already a number of reporting mechanisms built into that system. And so that group isn't really going to be hit as much. It's going to be more the small guys. And again, we'll get into that a little while later. You're going to have to file these BOI reports, these beneficial owner information reports, with about senior officers, other entities that maybe own a company that are not themselves exempt, and everyone is going to be held accountable for that. So you could have a situation where there's these penalties and they're holding the company accountable and they're holding the senior officers or other officials accountable as well. And so it's just something else to note, that I know there's been a lot of talk recently with some of these criminal matters or even civil matters where folks are upset, the folks meaning the entire populace is upset that these companies are getting what looks to be minuscule fines and the individuals responsible for these things aren't getting hit. Well, this is a way they're trying to remedy that in their mind, where they can help hold the individuals responsible as well. So then it comes to, well, do I have to worry about this or not? What, is this even something that's important to me? Well, the vast majority of privately owned companies are going to be subject to this. And that's if you look at it nationwide. If you take a sliver of the companies that are maybe federal contractors or companies that are well established, doing a decent amount of business, they might be exempted. And again, we'll get into the exemptions, but it's one of those things that it's the smaller guys. So if you're a company that has less than 20 employees, or you're a company that's under $5 million a year in taxable revenue, you're going to get hit with this the most. And so the government thinks that there's some 32 million entities that are going to be required to file this. It's more paperwork. It's mostly online, so it's not something that is a huge burden, but understanding the nuances and who you have to report is something that can be confusing. And in addition to that, my experience with all these programs, whether it be PPP or this program, the companies that are least equipped to understand the nuances are usually the ones that are most afraid of the consequences and will be the most worried about filing something and will likely get hit with most of the cost or the burden here, with emotional, financial, and otherwise, of reporting. And I know, just again, from dealing with PPP, The guys who were getting $60,000 loans and $100,000 loans and $200,000 loans, they were freaked out when they found out that there could be repayment and there was ambiguity in whether or not you had need and you should have taken it. So many of those companies just paid the money back. They said, I can't handle this. It's too much stress. Similarly here, you're going to have a situation where, sure, if it's a single owned company, you might think that's all you have to worry about. But what about other people that might control the business that are involved? What about people you give sort of synthetic equity to, or you have option plans, or what about you have a board of directors? What if you have a board of an advisory board? Does that count? Shouldn't. But there's all these questions I think these smaller companies are going to have to wrestle with. And again, I think they're the least equipped to understand it and the least equipped to afford the type of work that might go into analyzing things, especially if they're a small business with somewhat confusing ownership structures due to estate planning or family gifts or all that kind of stuff. So again, we'll get into that, but that's an unfortunate result of some of this. Now, I know we've sort of referenced this when it comes to exceptions. And so generally, any company that is already having to submit some information to the federal government is exempt from this. Most of these exemptions, you're never going to have to worry about. It's not the kind of stuff that companies that are probably on this webinar right now are really worrying about. So banks, money services, major accounting firms, things that are registered with the SEC or other government entities, not something you're probably having to worry about. Some of the other exemptions, though, like large operating companies, and large is a subjective term, and we'll get into this in more detail because I think this is the most important exemption. But U.S.-based entities, less than 20 employees, less than 5 million in annual revenues, are going to be exempt. Now, again, there's some nuance there we'll talk about. Wholly owned subsidiaries of exempt entities. So if you have an exemption and you own a company, that subsidiary is automatically exempt. So you have large companies and private equity funds and venture capital groups that are all exempt at the higher levels, and they have complete ownership over everything below them. The whole family of companies doesn't have to worry about this. Inactive entities. So this is a little odd too, because it's something that's before 2020. So magically on January 1st, 2020, the government decided that even if you're inactive, you should be reporting. But if it's December 31st, 2019 or earlier, you don't have to report an inactive entity. Inactive entities are really inactive entities, not an entity that you say, well, I'm not really doing any work. It holds some real estate for me and I pay it rent or something. It's probably not inactive in that case, because an inactive entity has to essentially have no revenues, no transactions flowing through its bank accounts of more than $1,000. It had to have existed before that January 1st, 2020 date and really be inactive. You're doing nothing with it and it's just sitting there and maybe you just forgot to dissolve it or something else. My guess is that they're looking at this timeline and saying, well, we don't want to pick up things that have just been sitting on the books or maybe administratively dissolved or still technically exist, but they're in bad standing and people aren't even doing any work with it. So they had this cutoff point that's somewhat arbitrary, but it is a cutoff point that you should be aware of. And just because you have some companies out there that you're not doing anything with right now, it might not meet the full definition of an inactive entity. Just be aware of that because of some of these rules. Tax exempt entities. So if you have a 501c charity, I have a number of clients that, especially after they've grown, they might be working with a charity or setting up a charity organization. Those organizations are also exempt. I think the main reason for this, if you think about it, kind of makes sense, is that there really aren't owners of a charity or a nonprofit. They're people who run it, but there really aren't owners. Like no one is really benefiting from it. It's the public that's benefiting from it. So in that sort of situation, it makes sense. companies that are supporting charities as well, if that's all they do is they give sort of accounting support or other support to tax exempt companies, they too can be exempt. So it's interesting how some of these exemptions came into play in addition to some of the banks and others. I think I was going to pull up this list. So security reporting, governmental authorities, obvious banks, credit union, money servicing companies, brokers in securities, because they're all, again, these are people that already report. Other companies that are Exchange Act registered because they have to report under the Exchange Act. Investment companies, venture capital fund advisors, Commodity Exchange Act companies, certain accounting firms that are major accounting firms, public utilities, pooled investment funds. There's 23. But again, most of them are going to have nothing to do with your company or how you operate your business. So just be aware of that. One key exception, and this is where we were talking about the large companies. So I think this is the one that's going to apply most broadly across the board. It's going to hit, I think, a lot of the companies that we work with and a lot of our clients and a lot of federal government contractors, at least after a certain amount of time, because it applies to any entity that is US based and has a facility in the US, has 20 FTEs or more, and more than 5 million in sales. So and that's based on your tax return. So if you've hit those metrics, there's this exclusion, and it's a rather large exclusion. I think, again, the idea here is that if you're operating and if you have a business of that size, the presumption is you're doing something legitimate. And so there isn't the same level of risk that they think exists in other areas, where if you have a smaller company that's maybe funneling a little bit of money here and there, and so therefore we need to know who owns this because it's suspicious that there's smaller companies that are money's flowing through and we're not sure where it's going. Presumably they've done a lot of research and made determinations as to where's the bandwidth where the most, or the bands where most of the money laundering is happening. What are we talking about? We're not talking about money laundering of the scale of drug cartels and things like that. Most of this is smaller scale or terrorist groups that are funneling money around. They're not moving tens of millions of dollars around, generally speaking. So that's where this is really targeted. Another thing that I think is going to come up for a lot of federal contractors, though, is you might be a larger company. You might have 5 or 10 million in sales. You might have a physical location based in the US, but potentially you have a lot of 1099s. I know that's becoming more and more popular. Now, if you're a small business and you're doing work that's susceptible to limitation on subcontracting rules, you probably shouldn't be doing a lot of work with 1099s because they're generally considered subcontractors in most cases. So if this is really talking about W-2s, and if you have a lot of 1099s, or you're a 30-person firm and you have 5 W-2s and the rest are 1099s, or if you're in a situation where folks demand to be 1099s because you're doing a lot of high-end staffing work, or you're doing medical staffing or things of that nature, a lot of those folks want to be 1099s. And just an example, I know there's plenty of examples of companies and professions that are turning more to 1099s. But if you're relying on 1099s, you might still have to be reporting it because they're not going to count. Also, the FTEs have to be 30 hours a week. So you might have hub zone companies that have many more than 20 FTEs, but potentially if you're looking to hire people to just hit those hub zone caps, people are only working maybe 10 hours a week. So they're working 40 hours a month to hit the hub zone numbers. Well, those individuals will not count. None of those individuals will count as employees. So even if you're doing 10 million or 20 million or whatever, and you've got a lot of W-2 employees, if they're not hitting those numbers, they're also not going to count as FTEs for the purpose of this rule, and you'd still have to go forward with the reporting. When it comes to the 5 million number, you're talking about 5 million in the aggregate across all your affiliated entities where there's a consolidated tax return. If you have scenarios where you have affiliation as defined in other rules, so you might have SBA affiliation where it's your mom's company and your company, and they're completely separate from an IRS perspective, but you're affiliated for SBA reasons. That has nothing to do with this. This would be the aggregate revenues of companies that are all filing consolidated returns and coming together. So, for example, you have an LLC that has a bunch of subsidiaries, and the LLC is either an S corp or it's a partnership. Either way, all that lower tier revenue is going to flow through and be reported by the LLC, technically the owners of the LLC, but same difference. It gets flowed through, and you look at that entire number. However, it has to be U.S. revenue. It can't be revenue from like overseas entities, even if they're technically affiliated through this test. Those revenues don't necessarily count. And I think that's also because if you had a high level of foreign revenue, it's a higher risk factor that there's some of these other issues that they're really trying to look at. And so they still want you reporting, not just a function of large companies. It's large companies that are doing a lot of work in the US. I guess the idea is they have more to lose, or there's less of a risk there. Also, it's based on prior year tax returns. So if you didn't have a tax return, you're not going to be able to avail yourself of this exemption. So it has to be after you file some tax return. This can come up if you're separating companies. Let's say maybe you're planning something in the future. You're planning an M&A event, and you're a small business, but you've now grown. So you were a small business last year, you grew this year, and you're trying to break off some revenues. You're trying to reorganize yourself to try to get small again down the road. Maybe in 2 years, you sell off some subsidiaries and you push them out. Well, if you're in a situation where you're restructuring companies and your main business is now you put a holding company above it, okay? That holding company might be a reportable entity. And if that holding company, because it doesn't have any revenues or it's brand new, right? That holding company might now have to be reported. And if it owns the lower business, that entity might need to be reported unless you meet one of the other exemptions independently. And if you've broken it apart or created a bunch of subsidiaries and moved things around, you could break yourself up to a certain extent that you no longer avail yourself of this kind of exception. So again, it's something to pay attention to because these things can change over time. And there's other things that could change over time that we're going to get into in a minute as well. But I didn't know if, Paul, I know you were looking at some of the US versus non-US stuff. Do you have anything to add here?
Yeah, no, I think if you have a foreign operation or you're a foreign entity, then there's a lot of extra considerations because the idea is that they want to catch the widest net possible. So, for example, within this large company exception, the 5 million in sales is domestic. So that's why it's important to refer back to your US-based tax return. They're going to look at the amount of sales within the US, and importantly, foreign sales are excluded from that number. And the idea is that you can't bring the benefit of that other 5 million maybe in foreign sales to meet this exception. And you will have to report if you are falling about $5 million of domestic sales. And then in general, if you have foreign entities or foreign persons involved in the company, then there's going to be another set of exceptions and rules and criteria for each of those. So that's going to be kind of a piecemeal case by case analysis of what kind of, I guess, ownership or control that person has.
Yeah, so any sort of foreign involvement, just put a note that you should double check everything because there's a lot of other stuff involved here. Another piece that I just wanted to note is this exempt company ownership because I sort of touched on it, but especially in the GovCon space, a lot of people do joint ventures, and joint ventures obviously are new companies and they're very small. They don't have anything. And under the SBA rules, they can't even exist really for more than 2 years as far as your bidding life. And then maybe they'll go on for another 5 or 10 years if you win work, but they're limited purpose entities for a limited period of time. And so, sort of by their nature, people don't want a lot of administrative headaches dealing with it. Sure, you set up the LLC to protect yourself, you file some stuff at the state, and you go on your way. The good thing here is that if you have two entities, or 3 or 5 or 10 or 15, however many owners you have of your JV, if all of those companies are exempt, they all meet some exception, one of the 23 exceptions, the most common is probably the one we just went through, then your joint venture that you just created that's brand new would also be exempt. However, if any of the companies are not exempt, then the joint venture is going to have to report the beneficial ownership. There are some shortcuts if you are reporting a beneficial owner that is exempt. You can generally, up the chain, you can generally report just the entity. You don't necessarily have to report the individuals if they're not otherwise reportable for some other reason. So that is something that makes it a little bit easier. But at the same time, I know with small business joint ventures, you could have a scenario very easily, especially with some of these large IDIQs. And I know PAX 3 is notorious for this, and then they've changed it a little bit. But people were having JVs with 30, 50, tons of different companies. And when you start to get that large in the cap table, the likelihood you're going to have to report goes up substantially. Because if you have anyone who's in there as an owner, it doesn't count anymore under this exemption. So you're going to have to start reporting. But for smaller JVs where everyone is exempt, you're good to go. Let's see. So if you've got other things here like this exclusion or exemption through certain businesses that are owned by inactive entities or owned by companies that are exclusively assisting nonprofits, there's some other nuance there. I don't think these things are really going to apply to most people here. I think most folks are probably dealing with for-profit entities, and in the GovCon space, if you're growing, you could potentially get hit by this other exemption and not necessarily have to worry about some of these things. But again, it's one of those things just to be aware of because it's not on everyone's radar today that when they're setting up these joint ventures, which is very common now, that there's an added level of reporting that's going to have to be done. And because of the level of reporting and the amount of the potential fines that are going to exist, if you go on and on and on at $500 a day, that's going to add up very quickly. And so then there's a question of, well, whose responsibility is it? Let's say you're in a mentor protege and you're the protege firm and you're pretty small and you're trying to set this up. This might not be on the mentor's radar that there has to be this reporting, but you're the managing member of the LLC it's created. Arguably, it's your responsibility to set this up and to do the reporting. And as days go by, those fines could significantly increase. Now we'll see how much this is really handled or how it's handled by the government if they're really going to hit people. But it's just something to be aware of. And another thing on the checkbox when you set up an entity, it's just like, all right, setting up an LLC, I got to get my register in the state, I got to get my EIN, I got to get my SAM profile set up, I got to get my UEI, and now, hey, I got to check to see if there's reporting here. If there is, I have to do my reporting. Just another thing to check the box on. All right, now kind of talking about who gets reported. Oh, yes. There was a question.
Yes, can you hear me okay? We need to take some time to look at the chat and the Q&A.
Anna Kate, I'm there's an echo on your end, I think, whenever you're unmuted, but I'm going through the Q&A right now and I'm answering some questions as I can, and my plan is to circle back and any ones that I think are generally applicable, tell those to the group as well.
Okay. Yeah, and I guess, Paul, there's something, I don't know, do you want to pick one of these and just talk about it right now, or do you want to?
Yeah, so one example was I think you kind of hit on it a little bit, but the 5 million, is that gross or net proceeds? And the answer is it's 5 million gross based on your most recent U.S. tax return. So that's a clear answer there. Do sole proprietorships, are they required to report? And the answer is probably not. The guiding principle is whether a entity is required to file a certificate with the state. So like you think about articles of organizations for a LLC or articles of incorporation for a corporation, you don't typically have to file a sole proprietorship organizational document with the state. But if you did, I can't think of any states that would, but that would be when you'd have to, is if you had to file anything with the state to operate a business. Let's see, is the information reported intended to be public? It's not publicly available database, and depends on how much you appreciate and respect the government's ability to maintain things privately. But no, it's not intended to be a publicly available database and is supposed to be only searchable by federal and certain other agencies that would need to know. So that's kind of the answer there.
That's where, though, I just think, and I sort of touched on this earlier, there was that whole lawsuit about the what was it, diversity hiring information, that someone filed a FOIA report, and that my understanding is the government lost that case and was going to have to turn it over. They are appealing, because we've got some clients involved in that. They are appealing that case to try to fight that. But it's possible, on that same sort of reasoning, that is this information really something that should be protectable? So who knows what's going to happen, not to blow it out of proportion, but it's just something we're also keeping an eye on, because I could see news organizations, or like I mentioned, these aggregator sites and other people having an interest in this and claiming there's a public interest in some of this information. So we'll just have to see what they do with it.
Yeah, and so I'll also just kind of hammer home here before we get into the next step. This is the beneficial owner, so you have to report certain people, but only if the entity is required to report. So the slides prior to this were evaluating whether the large business exception applies or it's an inactive entity. So that's important because it's a yes or no question. And if you're not required to report, then the rest of these slides don't matter to that one entity. So with that in mind, that first initial step is to figure out whether a given entity is required to report. And then we're going to move into what are they required to report. And that's this beneficial ownership information.
Yeah, you want to run through this?
Let me go ahead and jump into that. Sure.
Yeah,
sure. So let's just assume that a entity is required to report. And this is the next question, is what is a beneficial owner? Because that's what we're going to report, is who are the individuals or entities that own or control 25% of the ownership interest. So that you can think of that as a traditional owner. But there's this really big area here called exercises substantial control over a reporting company. So the ownership is sometimes clear, and we'll go into a slide next about why that might not be the case. But substantial control is very broad. And that's where you're probably going to spend a lot to figure out whether a given individual exercises substantial control. And there's a few caveats, I think, important to know, that an individual could be one or both or either. The only answer is that if if an individual is one or both, they have to be reported as a beneficial owner. It doesn't matter which area they qualify under. So if you have a 100% owner and you have a CEO, both of those are probably required to report. But you just list either as beneficial owner. And if they're the same person, then you only report them once as a beneficial owner. But stepping back, your average company is probably going to have at least one person that fits this definition of either ownership or substantial control. Anything else to add there, Si?
Thought of something too when it comes to, just giving the audience, when it comes to size protests, I could see a situation where the SBA, even let's assume this stays completely private and all these FOIA challenges or whatever is going to happen in the future, they all lose. I could still see a scenario where SBA is able to access this information to verify what you tell SBA in your Form 355 if you're protested. Or they could add it as another review when you're going through any sort of 8A, serviceable vet, woman-owned, whatever application, to cross-reference this database to see, are you telling one group, part of the government, a different thing than you're telling another part of the government. So that's another thing I just thought about as to how this stuff could be used. So just, be aware of that.
Okay, so directly or indirectly, this is, we're just talking about the ownership interest part of that, not the substantial control. Let's put that test aside. So now we're just talking about who actually owns a given entity. And, if you have a complicated parent and subsidiary relationship, then it could get tricky here. But in general, it's direct or indirect ownership. And I think I work a lot with privacy trusts and family trusts that might own the company. So I think that's where the biggest kind of question is going to be here on indirect control or indirect ownership. So clearly a trust that owns 100% of a reporting entity has to report, but who? And I think your average trust will probably report the trustee and then maybe one or more other individuals if a beneficiary has control over the trust. So looking at all the guidelines on direct and indirect ownership, it seems like these are kind of the two areas where people might have concerns, is where multiple parents own portions of a subsidiary. And then if a trust owns the ownership interests, does that mean that the beneficiaries of the trust also have to be reported? And I can't give you a clear answer. All I can say is that you should certainly look into it and evaluate each of the trusts that might need to be reported. The other half of this kind of definition is, what are ownership interests? And we have it listed here, but it's shares of any sort of equity, voting units, voting rights, convertible instruments, phantom stock, profits interests. And important to note that, for example, of phantom stock, it's going to be treated as if exercised and converted. So not even if it's freely revocable and if they leave the company, it's restricted and it's never actually going to get to them. It doesn't matter. It's treated as if it actually was awarded. And then they have this other catch-all here, any other arrangement that could be interpreted to establish ownership. And importantly, there's a exception for creditors. So you might see where somebody has a personal guarantee or a guarantee on behalf of the entity where it could give a creditor potential control. That sort of relationship is excluded. But you can think of any other arrangements where there might be a financial benefit to someone that could be considered ownership. Anything else there, Si?
Yeah, and that's pretty similar to some of the SBA stuff. So in that vein, it's somewhat consistent as to owners.
Okay, so next slide here is substantial control, and this is again different from ownership. Ownership and substantial control are both reportable as beneficial owners. If you own equity, that's an actual owner that we talked about that on the last slide. This is substantial control, and what I've listed here are the clear areas where the FinCEN has said these people exercise substantial control, presumably. And they may or may not, but these are the types of people that you would expect to have substantial control. So senior officers, and they give the specific examples of president, CFO, GC, CEO, and COO. And if they have the ability to appoint or remove certain officers or majority of directors, so not just a single director, but if any one individual can basically control the company through appointing certain people, then that individual is also exerting substantial control. There's kind of two catch-alls here. If they're an important decision maker, and this could be pretty much anybody that might make a decision to impact the business. And then finally, any other form of substantial control over the reporting company, and they refer to this as the catch-all, but it really could be any of these last two, that a given person might have substantial control over what could be an important decision or what could be considered substantial control. As you're evaluating any given individual, keep in mind that the idea here is to cast a broad net. So the criteria are broad, intended to capture as many individuals as possible that might be considered to have substantial control. There's no disadvantage to reporting people if you aren't sure. So the default should be to over-report as opposed to under-report. As opposed to, Sai's going to get into this in a minute, but SBA, you want to be clear about who has control, and it should be the qualifying individual, for example. But in this, it's okay that other people might have control, but I think it's important to kind of make sure that as you're analyzing your SBA criteria and the CTA criteria, that it's substantial control doesn't bleed over between the two analysis. Anything to add there, Sai? I think we have another slide on the next one about specifics to
SBA. I think we can probably say it next time, but there's definitely I'll say it at the end.
Okay. So this is I think the best comparison for what control means under SBA rules versus the CTA, the Corporate Transparency Act, is a CFO. A CFO is generally not considered to have control over the day-to-day operations of a company that the SBA requires. So your typical CFO does not meet the definition of SBA control. But a typical CFO does have significant responsibilities in managing the company's finances. And that's an example of someone who should be reported under the CTA. Again, the point is that CTA is intended to capture a broad breadth of individuals who must report.
Yeah, I think that's in the context of people that are directly involved in the business. The CTA is broader. When it comes to people that are not involved in the business, SBA's rules are broader. So don't get them mixed up. I think we actually had a question about spouses. Are spouses considered to be beneficial owners? If they have direct ownership, or if they're in substantial control of the business, potentially, right? But not just because they're your spouse. Whereas if you have something under SBA rules, if you own a business and your spouse owns a business, those two businesses are presumed to be affiliated with each other unless you can show clear fracture, which you can certainly do. It's a whole nother analysis that you have to go through. But in theory, you could fracture those things. And so you could have a situation, though, where if you're not fractured, you're affiliated for SBA, but the two of you are not beneficial owners of each other's companies because you don't have substantial control in each other's companies. So just to be clear, they are different standards. Now, what I was saying earlier with SBA potentially having access to this, I could see a situation at some point where SBA starts to cross-reference its information with this, and they might ask questions. It doesn't mean they're going to find a problem, but if you're reporting certain individuals as having substantial control, I could see SBA saying, well, wait a minute, why did you do that here and not here? What exactly does that person do that made you report them over there? And why are you not reporting them over here? And those kinds of questions I could definitely see starting to get asked if SBA gets access to this or starts requesting access, and that the government starts sharing this information across agencies, which is another way this information could leak out, so to speak, is you could have a scenario where SBA starts to get access to this information. They prepare size determinations, and in the size determination that gets released to your competitor, because if you ask for them to send it to you first to redact, sometimes they'll do it, sometimes they won't. If you don't ask, they're just going to give it to whoever filed the size protest and you at the same time. So that information could get out in that way too. So that's not saying like, what do you do to protect yourself from that? You can't lie, right? So if there's a basis to say, hey, I need to report this information over here, you just got to report it. And then to the extent SBA starts looking at things, you got to deal with it. If they start releasing information, size terminations, or it gets somehow public, and now you're getting hit with size protests and it's just a huge pain to deal with, unfortunately, that's kind of just the reality of the way the system is currently set up and what could happen with this. But as of now, again, this is not public information. It's just what could happen in the future and understanding the nuances and the differences here.
Okay, so this is a completely separate category of people who must be reported. It's company applicants. So for an entity that's required to report, they have to report all of their beneficial owners, who could be people with actual ownership interests or with substantial control. And then they must also report their company applicants. And for a typical kind of business in this area, they use a law firm to set up a business. The lawyer at the law firm is the person who probably directs and controls the filing action of the initial paperwork for that entity. So presumably the attorney is your company applicant. And then whoever actually files that articles of organization or certificate of incorporation with the state secretary of state, that other person, if they're different, must also be reported as a company applicant. So you have to report at least one and at most two company applicants on any report that you're required to file. I assume that most of the people on this webinar have existing entity. So the important caveat here is it's only for those on or after January 1st, 2024. So you don't have to go back in time to figure out who was your company applicant. But going forward, as you organize an entity, keep track of who is this person that directed or controlled the filing action, who prepared the certificate, and then who actually filed it, if different. So that's company applicants, another category of people that must be reported. Okay, so the deadline varies based on when the entity was filed. And if it, for most everyone on this call, probably you existed before January 1st, 2024. So you have a full year that you have to report. I think the intent is for entities to go ahead and start filing their reports as soon as possible, but the deadline is January 1st, 2025 for entities created before January 1st, 2024. And if you created on or after January 1st, anytime during 2024, you have 90 days. And then starting January 1st, 2025 and going forward, any companies created on or after that date, you have to file within 30 days of creation. So there's a question in the chat about this, that if you lose an exemption, then you must report within 30 days that the exemption no longer applies. So the example of a large entity, if your most recent tax return reports less than 5 million in gross sales or receipts, now you have to report, and you have to report it within 30 days of your knowledge of that exception no longer applying. And then if there's any change in your reported information, so the classic example is a change in ownership that creates someone going above 25%, or maybe the COO or your general counsel, if you switch out the personnel that hold that title, then within 30 days of that change, you have to update the BOI report. And that's an ongoing requirement. You don't have to file an annual report, but just any time the information that's been reported changes within 30 days of the change.
Yeah, and I could see this coming up too when we're talking about the joint venture stuff, because let's say you have a JV and all the members are exempt, so the JV is exempt. Well, if something happens to one of the members and they lose their exemption, that would also cause the JV to lose its exemption. So then you have a reporting obligation for the other entity. And let's say it's not the managing member that loses it. There should be some mechanism whereby, like in the operating agreement or something like that, that it requires the entities to notify the joint venture of any sort of change in status here, because that's going to trigger a reporting obligation of the joint venture as well. And then we had a question. I don't know the answer to this other than I believe you would just do your report within 30 days. But what about the opposite, Paul? Do you know the opposite? You grow, you do your report within 30 days. You're like, oh, by the way, I'm exempt
now. The guidance isn't clear on that reverse situation right now, so we're not sure. It's a good question, not sure.
But just to be clear, this change in status piece of it, or if any sort of beneficial owner changes, that just has to happen within 30 days. So keep track of that. And that's especially true, I think, if you're talking about changes in officers, or let's say you have someone that had a phantom interest and it was substantial and they leave, or someone who was in control of the company and they leave, or they die. You got to keep this stuff up to date rather quickly. So it's another thing just to make sure you're aware of that and keep it on the radar, because anytime any of those people change, you should probably have some easily accessible information within the company so that you can trigger this quickly. Go ahead.
Sure. So filing, let's assume that you have to file and you've already analyzed who needs to be reported. The actual reporting mechanism is fairly easy to use. It's a reporting tool known as BOSS or the BOIR on FinCEN's website, the BOI report, BOIR. And the tool allows you to report your entity formation information. And then for each beneficial owner, you report full name, date of birth, current address, and then some sort of unique number. And then whatever unique number you're relying on, you have to supply a copy of that document. So you can think about, for your general counsel, going to find their individual information and reporting that for them and asking for a copy of their passport and social security number might be a trouble to obtain. So working on this early to see if you can work through any issues that an individual might have with giving you that information. And if they do have an issue, there's an alternate where any person that's required to be reported can volunteer their information to FinCEN, and you'll be supplied with a new individual number, the FinCEN identifier. And that individual number, the FinCEN identifier, can be given to the reporting company instead of all this information here. So that's an advantage of somebody who's proactive in reporting their own information. They can just share the FinCEN identifier. Okay, so I think we've hit on this consistently, but again, small businesses are that's the intent of who this is going to capture. It's most of the small actual operating entities in the country are going to be required to file a lot of information about their ownership and substantial control individuals. And again, as I said earlier, these small businesses are typically least equipped to be able to handle this reporting and keeping track of any changes to the ownership information. So I think that's where the impact is going to be significant and ongoing to file the initial report and then track it going in the future. The Small Entity Compliance Guide is a formal publication from FinCEN that gets updated regularly. So if you have any questions, that's where I would start, is figuring out whether you're exempt or whether the ownership needs to be reported or whether you need to provide an update on your BOI report. This Small Entity Compliance Guide is a good first start. And if there's any uncertainty at all, I would say reach out to Cy or I or your attorney to figure out whether a report needs to be filed or an update.
Yeah, and I think that's pretty good. It's also similar, not to keep comparing this to SBA, but it's not that different. It's similar to the way SBA purposefully has their regulations structured. Like SBA has it structured as almost a Q&A, right? All the regulations are questions in most cases, and then they go through. It might not be the easiest thing to understand and read, but it's set up that way to try to make it a little bit easier. Here, there's a great FAQ that is going to take you through a bunch of the questions that apply most likely to the companies that are of that size. Because most likely, again, you're not going to have incredibly complicated cap tables or ownership structures. You're not going to have a bunch of tiered entities or complicated trusts of various types. You might have grantor trusts and things of that nature that are much simpler to handle than some other types. So I would go there first and try to see if you can find some of the information, because it's probably going to answer the stuff for the smaller companies out there, as opposed to some of the more complex structures of small, qualifying entities. Go ahead, Paul. Oh, you're on mute still.
There we go. What should you do to prepare? This is a step-by-step. The first step is determine whether an exemption applies, because again, it's a yes or no, it's a switch. And to figure out if you are exempted or your entity is exempted, then no reporting is required at all. And then if you are required to report, then figuring out each person that must be that's a beneficial owner, meaning that own 25% or more directly or indirectly, or they have substantial control. And then collect information for each of those individuals, file your report, and then you've got to establish some sort of policy to track changes or to require people to report information to you. Because keeping this updated into the future, especially in a couple of years after the initial report, it's going to probably slip to the back of your mind. So having some sort of reminder mechanism to file any updates that are required.
Yeah, and that goes, there was a question about when will folks be notified, and there is no direct notification. It's not like you're going to get, well, at least I'm aware of, that you're going to maybe they'll send something out, or states might generally blast something out. You might get something from the accounting firm, or does your taxes, something like that can happen. It's interesting though, because I've talked to the Department of Justice on other issues where there's some big change, or there's some policy that they now have that they want to get the word out. And the DOJ folks have told me that they don't release things. They don't have any formal mechanism because they feel they don't need it, because they think there'll be a sufficient number of law firms and accounting firms and other folks that will put out information for them. So that is the formal process at, say, the Department of Justice for notifying individuals or companies of various changes in law or obligations. It's essentially, it's very American if you look at it that way. It's like outsourced, let the invisible hand handle it for you. That's essentially what I think is going on here as well. So they've released information. They might try to publicize things. I'm sure you'll see plenty of companies do it, but this is, you have to do it. If you qualify, that you have to be reported, and you were in existence, right, prior to 2024, you have until December 31st, 2023. So, or 2024. You have to report this year at some point. That's the answer. You're not going to get other notification, or you can't just say, well, no one ever told me. Well, it doesn't matter. The law changed. It's your obligation. So I think everybody who's on the webinar here has a leg up in that regard. Another quick question we got about notifying when you close a business. That I also don't. I would think you could say it's a change of beneficial ownership and just notify them, and that's that. But do you know, Paul, off the top of your head, if there's expressing something on that? No.
Now, this is the same as the question about the reverse of somebody going from right, small to big. How do you update the report? And there's no guidance on there at all.
I forgot to put Paul's information on here. Well,
I'm Paul.
Could always have his information. Is it up front here? I'll go to the beginning here. There you go. There's Paul's email address and my information. I think this will be available to everyone, and so hopefully folks can reference back, and if everybody has any questions, just let us know. Really quickly, a couple other questions we can go through. Yes, so the one question is, sorry I missed it, but when can we report? Yeah, if you were in existence prior to this year, you've got this entire year to deal with it. If you create a new entity this year, then you have 90 days to deal with it. And if you create a new entity later in time, in 2025 or beyond, unless they change it, you have 30 days to do the report. And if there's any change once you've filed a report, you've got 30 days to report that change as well as far as beneficial owners. So those are the general timelines that you have to deal with and remember. And then, yes, and last question, I think we're out of time, is about other questions that were submitted earlier. I think, yeah, we'll have those, and then we can respond back to the extent that we can, or any of the other questions that we didn't get to, we can respond to those as well independently. So, yes, thanks everyone, and hope everybody has a great day.
Thank you.